Hi everybody, hope you're doing well. Moving on to our next video here about the economics of coronavirus. Um, in this one, we're going to be moving on from our introduction to the monetary system into some of the more traditional forms of monetary policy. And just to start, I want to show this photo here and have you take a look at it and see if you can figure out what that is. So maybe even pause the video for a second and try to figure out what's going on in this piece of art. And if you take a close look at it, what you'll see is you can kind of make out an outline of the world. And so you've got the continents there. And what this piece of art is showing is in the wood, it's showing GDP. And in the wire, it's showing the financial flows around the world. And so actually, you can see that the amount of money flowing around the world, either physically or electronically, is actually even much larger than the true value of the output produced, the GDP around the world. So kind of an interesting look at how significant the monetary system is, the financial system is, and ultimately one of the reasons why looking at monetary policy is so important. Yeah, one of my favorite pieces of art, particularly since I'm into woodworking myself a little bit. I think it'd be really cool to try to make something even close to that. But regardless, I just wanted to start with that. A little bit of a motivating picture. So that image is called the fundament. I'll try to remember to put up a link that goes to that website. Okay. Anyway, let's dive in here to the notes. So what we've got here are these traditional monetary policy tools. We're going to start with the goal, which we discussed briefly in the last video, and then look at these three different policies in more detail, also introduced briefly in the last video, but we'll look at the discount rate, reserve requirements, and open market operations, how they work in practice, and how how they have been used recently, and how we may be able to continue to use them going forward. Okay, so let's start with the goal of monetary policy. Ultimately, if we start with the idea of GDP, gross domestic product, our kind of simple formulation of that is consumption by households, more or less, plus investment, plus government spending, plus net exports. Okay, so trade policy is responsible primarily for net exports. Fiscal policy is primarily responsible for government spending, and to a certain degree, fiscal policy affects consumption and investment as well. But monetary policy here, this is really what monetary policy is going to be focusing on, trying to increase consumption and increase investment through decreasing interest rates. So monetary policy's ultimate goal is to decrease interest rates. And in doing so, that's going to decrease the cost of borrowing, right? So now individuals and businesses, if interest rates are lower, they can go to the bank and they can get a loan for a smaller price. Ultimately, the price of money, or the price of a loan, is the interest rate. So if interest rates go down, the cost of borrowing decreases. Therefore, borrowing itself increases. And that's going to happen through investment, primarily through businesses, investment, and consumption from households. So households, investment in new cars, houses. Actually, technically speaking, new housing falls under investment, but nonetheless, mortgages, cars, consumer loans, commercial and industrial, and commercial loans. So ultimately, monetary policy's goal is to decrease interest rates. And so we're going to look at the three traditional methods and how the Federal Reserve goes about doing that. And I will, I guess, go ahead and just mention this once, although in the last video we went over the Federal Reserve System in detail. But monetary policy is conducted by the Federal Reserve. Okay, and primarily the Federal Open Market Committee, who typically meets once every quarter, but actually they had two emergency meetings during this coronavirus crisis to conduct some of these monetary policy tools. Okay, so let's move on to those. The first one, which we won't spend too much time on, is more of a direct influence on the interest rates. Actually, really quickly, if we look here at the outline, the Fed can either directly influence interest rates through the discount rate or indirect, although I have indirect in quotes because even though they're not directly setting an interest rate with these two other methods, particularly with the open market operations, it's an indirect effect on interest rates, but it's very precise. The Federal Reserve can pretty precisely target a very small range. I'll show you that at the end. But let's start with this direct influence on the discount rate. And the discount rate is just the rate at which banks can borrow from the Federal Reserve. The rate at which banks can borrow from the Federal Reserve or the Fed. Typically very short-term loans, and often even just overnight loans to help meet short-term liabilities. So we're not going to focus too much on this, although the Fed has been using it. So you see in the gray bars here, gray bars indicate recessions. Here we have the financial crisis. During recessions, we want to decrease the interest rate. Again, if we decrease the interest rate, borrowing increases, consumption and investment increase. So during recessions, interest rates fall down, and in this case, they're directly set to be lower. As we enter periods of growth, eventually the interest rates start to go up again. But then here, coronavirus hits, and a little bit of turmoil in the financial markets and the economy. And so again, the Federal Reserve decreases the discount rate. Primary credit rate is the same thing as the discount rate. In order to encourage that borrowing and lending. So that's the discount rate. It's been used. It's now down to 0.25%, which is as low as it's been. Here we have 0.5% at the trough of the recession. So in recent history, we're at the lowest discount rates we've ever had. A lot of records being set in the financial markets with bond yields and monetary policy targets. So that's where we're sitting with the discount rate. Again, a direct impact on the interest rates, discount rate directly set by the Federal Reserve. Okay, moving on to reserve requirements. This one's going to take a little bit more work because I want to go through an example to show you not just the reserve requirement itself, but also how lending in an economy essentially creates new money. And so this is also going to be increasing the money supply. And as the money supply increases, as I'll show you later, increase in the money supply will result in a decrease in interest rates. Okay, so looking here at the banks and the money supply, actually I don't need all of this space here, but if we think about the function of banks in an economy, they're primarily doing fundamentally they're doing two things. They take deposits from customers, business and individual customers. So they take deposits. You take your money, you go to the bank, you put it in a checking account or a savings account. So they take those deposits, and then what do they do with them? They make loans. And through that process of lending, they're actually going to be inserting money back into the financial system, and as we'll see, they're going to end up in the banking system that we have and that nearly all developed nations have, the fractional reserve banking system. That's going to end up creating new money. So to understand that, we need to talk about reserves. And so reserves are essentially money in the vault, either money in the vault at the bank itself, or the bank can hold reserves at its regional Federal Reserve branch. But what we've got here are deposits that banks have received but not loaned out. Deposits that banks have received but not loaned out. Okay, so cash in the vault. Basically, think of reserves as cash in the vault. And we'll look at two systems here, 100% reserve banking and fractional reserve banking. This is not common, but fractional reserve banking is common throughout the throughout the world in general. Okay, so to look at both of these systems, we're going to use an example where we suppose that we're putting $1,000 into the bank. And then we're going to look at these couple different scenarios on how that money is ultimately used and circulated throughout the economy. So our first scenario, 100% reserve banking. And if you've had your accounting classes before, you should be very familiar with the T-table. If you've not had accounting class, you're going to get a crash course. We can generally think about a balance. Here we have essentially a small balance sheet. And we've got assets on one side and liabilities on the other. Little more. This is a simplified version, but essentially we've got assets and liabilities. And so on the liability side, if this is the bank, that $1,000 deposit is going to go into deposits for $1,000. So the bank is liable for that $1,000. They're liable to return it back to us if we go to the bank and we say, hey, I want to withdraw my $1,000. So the deposit is a liability, and we're just going to focus on that for now. So $1,000 total in liabilities. Technically, we could have borrowings here and owner's equity or capital, but we'll keep things simple. Now, what can the bank do with that money? Again, let's simplify things, and we can say either they can loan it out and it would go into the loans bucket, or they can keep it in their reserves as cash in the vault. And so in this case, we have 100% reserve banking, so 100% of our deposits need to go into reserves, and therefore $0 are lent out. And so the total assets are 1,000, and our balance sheet balances, right? Assets must always equal liabilities. So our balance sheet balances. Okay, in this case, it's really not that interesting. The bank is essentially just a place to hold your money. There's really no incentive to do this if the bank can't lend out anything, because the bank is essentially not making any money. Banks make money from loans. So this system is not, almost no banks would have a system like this. They wouldn't have any way to make money. Okay, and so in this case, the new money created through the banking system is 0. And we'll kind of see in the next scenario how that differs in fractional reserve banking. So more realistically, we have fractional reserves, and in this case, instead of keeping everything as a deposit, or all the deposits kept as reserves, the bank can lend out some of that. So again, this is the structure of most banking systems, and here we have a reserve ratio, and this is the fraction of deposits that banks hold as reserves. The fraction of deposits that banks hold as reserves. For a simple formula here, we have the reserve ratio, or let's say reserve requirement, times deposits. Okay, so if the bank has a 10% reserve requirement, then they put 10% of those deposits into their reserves, and then the rest of the deposits can be used to make money, primarily through loans. Okay, and so in this process, the lending that the bank is able to do with all the rest, so you have reserves and whatever's left over, make the loans. And so this lending creates new money. And here's how. The money that is loaned out ultimately ends up in another bank's deposits. Ultimately ends up in another bank's deposits. Which then a portion of that gets loaned out. A portion of that gets loaned out. And then, some of that loan is going to end up, or that loan is going to end up in another bank's deposits, and then so on and so forth, etc., etc., etc. Okay, so the idea is that I'll show you visually, and then I'll show you with some tables and some math. Okay, but let's say we've got a $1,000 bill here, or maybe 10 100s. And that goes into the bank. That goes into the bank, and underground in the vault, they keep 10% or $100, and the rest of it they can send out as a loan for somebody to buy a car. I wasn't planning on doing artwork here. There we go. Okay, so somebody uses a loan to buy a car. That car costs, okay, this is a cheap car because there's $900 left, and somebody's using a $900 loan to buy the car. Well, maybe they paid a lot of it, a large down payment, and they only financed $900. But ultimately, the car dealer, okay, so the car is going off to some, nice household. But then the car dealer, how do I draw a car dealer? This is the car dealer. He's got a top hat on. The car dealer is going to take his $900 to, it could be the same bank. Actually, let's call it a different bank. So this is another bank. And so that $900 is now in another bank, and then that bank puts $90 down in the vault and then loans out the rest of it. But ultimately, the first person who deposited this $1,000, they can still go to the bank and say, hey, I want my $1,000 back, and they'll get their $1,000 back. And then that person, they can go buy a car. And so, wow, okay, they can go buy a car. But then this person bought a car with $900. And so, now in the economy, there's $900 here that either this guy doesn't even have to take it to a bank. Let's say he doesn't take it to a bank. The car dealer now just has $900 that he can go spend. He can deposit it into a bank, but he could go spend it on something. But then also this first individual, they have $1,000. And so through the banking system, this $1,000 turned into $1,900. So the banking system has created new money. And this can go on and on if this $900 gets put back into a bank, that's going to go off to another purchase, and then that purchase is going to be put into the economy. And so the banking system is creating this new money through this continued process of depositing and lending, and then depositing and then lending. And so it goes on and on. So this is my very rough visual representation of this. Let's actually use some numbers. Something I'm a little more comfortable with than drawing. Okay. So again, we're gonna actually use the same numbers. $1,000 put into the bank, and we've got a 10% reserve ratio or reserve requirement. And so we're going to, again, draw another balance sheet here for that bank. Assets, liabilities, deposits, loans, and reserves. And total. Has to balance. So again, we're starting with our $1,000 deposit. 10% of that must be kept as reserves. And so that's going to be $100, 10% of 1,000, or just 1/10. And so 10% are kept as reserves, and $900 are lent out from the bank. And ultimately, whatever the reserve requirement is, banks are going to, most of the time, go right down to that limit. Because again, these reserves, they're not making any money for the bank. They're just sitting in the vault. The bank is making money through the loans. So they want to make as many loans as possible. So that 10% reserve requirement means $900 is going to be made as a loan and put out into the banking system. So, like we saw up above, the total money in the economy now is $1,000, which the original depositor, they can go back tomorrow and take out that money. But there's also $900 new money created through the loan. And so that's kind of what we had up here. Here's the new money and the original money for the total. Okay, so new money created in this first deposit is $900. Okay, and now we are going to look at this scenario where this car dealer with his top hat goes and deposits that $900 into the bank. That bank, again, they deposit $90, 10% of 900, and the rest of it, 900 minus 90 is 810. They're going to lend out again to some more customers. So that's what's happening here in the second deposit. We have assets, liabilities, deposits, loans, and reserves. Now, $900 has been deposited into it could be the same bank. It doesn't matter which bank it is. But $900 are deposited. 10% is still our reserve requirement, reserve ratio. So 10% of 900 is 90. The bank puts $90 in the vault and loans out the rest. 900 minus 90 equals 810. So that leaves $810 for loans. So the total liabilities are 900. The total loans are 900. Balance sheet balances, and we're good. But then now, the new money created in the economy comes from the new loans lent out, and that's $810. Okay, so now we have the original $1,000 plus $900 new dollars plus $810 new dollars. And this process is going to continue. This is going to go on to a third bank. This is going to go on to a fourth bank, fifth bank. And it's going to get smaller and smaller, but that initial deposit is going to be ultimately creating a whole lot of new money through this process of borrowing and lending in the banking system. And this is something that we can actually model out mathematically. There's this mathematical notation or mathematical formula called the geometric series. And if you have a series of numbers that look like this, actually assuming that x is less than 1, if this goes on into infinity, we have 1, which is actually equal to x to the 0, plus x to the 1, which is x to the 0, plus x to the 1, plus x to the 2, plus x to the 3, x to the 4, so on and so forth. 1, we could write that as a series. It's actually an infinite series. So I goes from 0 to infinity, where we have x to the ith power. If you want to write that in mathematically fancy way, that's how you would write that. But ultimately, a really nice mathematical result here is that this converges to the number 1 over 1 minus x. And with this, we can actually calculate the total amount of new money created in the economy through the banking system after one deposit. Okay, and so as we saw, the first deposit, we have $1,000 in the banking system. Second deposit, $900 of new money. Third deposit, $810 of new money. If you calculated it out, you could find the third deposit would give us $729, and so on and so forth out to infinity. Ultimately, what we can write this as is, this is 1,000, that's 1,000 times 1. Here, we have 1,000 times 0.9. If you do that, that comes out to 900. Here, we have 1,000 times 0.9 squared. If you calculate 0.9 squared, that's going to come out to 0.81. So this is the same thing as 1,000 times 0.81. And so that comes out to 110. And here we have 0.9 cubed. And then we're going to have 0.9 to the fourth, 0.9 to the fifth, and so on and so forth. And this first one, we don't have a 0.9 there, but we could multiply that by 0.9 to the 0 power. Anything to the 0 power is just 1. So that's ultimately 1,000 times 1. So that's 1,000. Okay, and so what we can do then is collect terms. And so we have 1,000 times, maybe we should have, times, I'm going to have to put it down below, times 0.9 to the 0th power, which is equal to 1. So for each term, we have 1,000 times 1 plus 1,000 times 0.9. Actually, let's keep it as 0.9 to the 0 plus 0.9 to the first power plus 0.9 squared, 0.9 cubed, on out to infinity. And ultimately, what does that come out to? Should have left a little bit of space here. Okay, and so this comes out to, as we see, this is our geometric series where, we had, where we have our 1,000 times, and ultimately this is the same thing as our 0, x to the 0, x to the 1, x squared, x cubed, so on and so forth. Just happens to be that 0.9 is our x. And so if 0.9 is our x, the result of that geometric series is 1 over 1 minus x. And in this case, that's 1 over 1 minus 0.9. 1 minus 0.9 is equal to 0.1, or equal to 0.10. We can take the reciprocal of that, and so we just get 1,000 times 10, or $10,000. Okay, and so again, this is our result, or our result for the the money creation, or the total. Actually, it's the total money in the economy coming just from that original $1,000 deposit. So $1,000 through the banking system becomes $10,000 through that system of borrowing and lending. Okay, and there's a simpler way to do this. All of this up here just shows you kind of the background on how this becomes possible. But ultimately, if we know the reserve requirement or the reserve ratio, all of this can be calculated through what's called the money multiplier. And so the money multiplier is the amount of money the banking system creates through the banking system. And this is simply equal to 1 over the reserve requirement or the reserve ratio. Okay, and so in our case, the money multiplier is 1 over our reserve ratio was 10%, 1 over 0.1, money multiplier 1 over 0.1 is just equal to 10. So we take our $1,000 deposit multiplied by the money multiplier equals our $10,000 of money in the banking system because of fractional reserve banking. Okay, and so now that we have kind of the underlying idea about how this works, let's talk about how this relates to monetary policy. So let's take a couple examples. If we have a reserve ratio or a reserve requirement of 5%, that's equal to 0.05, then our money multiplier is equal to 1 over 0.05 or 20. So in this case, beforehand, if our reserve ratio was 10%, that leads to a money multiplier of 10. If the Federal Reserve decreases the reserve ratio, the money multiplier increases. So if the Fed decreases the reserve ratio, the money supply in the economy increases, and therefore the interest rate will go down. On the other hand, if the reserve requirement is equal to 20% or 0.2, you could pause it and check it out if you'd like. But then the money multiplier equals 1 over 0.2, and that's just equal to 5. Okay, and so now compared to our 10% reserve ratio, if we increase the reserve requirement from 10% to 20%, the money multiplier goes down from 10 to 5. Okay, so let's summarize what that means here for the policy. If we lower the reserve requirement, or let's say lowering, or maybe let's say better to say decreasing reserve requirements means more loans will be made with the deposits. Decreasing reserve requirements means more loans will be made from deposits. As a result, or kind of in conjunction with that, the money multiplier increases. Money multiplier increases. New money created via the banking system increases as well. So money supply will go up. And therefore when the money supply goes up, interest rates fall. Interest rates fall. And then all of the good things associated with that: more borrowing, more lending, consumer spending and investment in the economy, increased GDP. Okay, so reserve requirements, decreasing reserve requirements ultimately is a good thing for the economy. And as we see, this is also again what the Federal Reserve does. I should probably hide the actual numbers here, but as you see, essentially here as a percent of liabilities, or essentially deposits, a couple other deposits, borrowings, but we can kind of think of this as our example. And so here we have just different types here, in particular different sizes of banks. And so for banks with different, here we have smaller banks, small, medium, and large. But actually, as you see, all of these banks are subject to 0% reserve requirements. And so a lot of this was done recently. Before this happened, the medium-sized banks had 3% reserve requirements, and the large banks had 10% reserve requirements. But just recently, because of coronavirus, the Federal Reserve decreased all of these reserve requirements to 0. And so we're at a limit with those. They can be effective now, but going forward, this is not a tool that the Federal Reserve will be able to use. But actually, also, just to give you a sense of scale, it used to be the banks with more than 127 million in deposits, which are many. They had a 10% reserve requirement. And if we just take one example, can I do this here? Yeah, if we just take one example, the largest bank in the United States, in the world, JP Morgan Chase. In 2019, they had total liabilities of, try to guess, $2.4 trillion. And so that means before these new policies were put into place, they had a 10% reserve requirement. 10% of 2.4 trillion is 240 billion. $240 billion, which is money that they had, but that they had to keep on reserve. So you can essentially think about it as keeping $240 billion in their vault. As of March 26th, that money is now available for lending or investing, or whatever other use they want to use, however else they want to use it. But now that money can be used in the banking system to encourage, and actually that's the idea. The Federal Reserve wants to encourage them to use it to make loans, to kind of spur demand, consumer and business demand in the economy, by making more loans at lower interest rates, because all of this increase in new money, all of this increase in new loanable funds is going to put downward pressure on the interest rates. So the idea, more people go borrow. And again, this is just one bank. So that's $240 billion now available for lending, just from one single bank in the country. And so now all sorts of banks who were falling within these two categories, who previously had a lot of money just held up, unable to be used, it's now free and free to be loaned out. And so that's going to definitely increase the money supply and put downward pressure on interest rates, which is the goal of the Federal Reserve in the first place. Okay, so I think that's it. Yeah, that's it for reserve ratios. So we've hit discount rates, we've hit reserve ratios, but actually the last one that we're going to cover is the most common monetary policy tool. And actually, as far as policies go in response to recessions, these open market operations that we're going to start on now are probably the most commonly used policy to help us stabilize or to grow, trying to get ourselves out of recessions for the past at least 50 years, but even before that. So very common policy tool, open market operations. Again, it's slightly more indirect, but it can be done with a lot of precision. And so let's dive into that and see how this works. So I'm just checking the time here, and actually what I want to do is leave it off here and pick up open market operations in its own video. And because it's the primary tool used by the Fed, I suppose it's maybe good to have it as a video on its own. So we're actually going to pick this up on the next video. I'll see you then.